Jenks Center. I'd like to welcome you here today. Today we're lucky enough to have with us, we are pleased and honored to have this year's keynote speaker, Thomas F. Woodhouse, CFP, who is the Principal and Marketing Director of Seaward Management. Mr. Woodhouse, who is a financial consultant and investor, will speak on what we have learned in the past 3 years. Tom joined Seaward Management in 2011 after 6 years at Fleet Investment Advisors, where he was a vice president and portfolio manager. While at Fleet, he managed investment portfolios for high net worth clients and charitable funds. Prior to joining Fleet, he was a senior municipal analyst for Federated Investors in Pittsburgh, Pennsylvania. His focus at Federated was analysis of securities for its tax-exempt bond and money market funds. Tom received Bachelor of Science degrees from St. Lawrence University in mathematics and Columbia University Mechanical Engineering in 1983 as part of a combined program. He received his MBA from Carnegie Mellon University in 1991. Tom is a chartered financial analyst and a certified financial planner. He is also a member of the Boston Security Analyst Society and the CFA Institute. You're a busy guy, huh? Originally from Providence, Rhode Island, Tom now resides in Midfield, Mass. with his wife, son, and daughter. Please, let's warmly welcome Tom Woodhouse.
Thank you. Thank you for that introduction. Pleasure to be here today. I'd first like to thank Winchester Seniors Association and Winchester Council on Aging for having me here. It's an honor. This is a wonderful event. I've been very impressed with the one, the turnout, two, the vendors, the products that are being discussed. I think this is all wonderful and shows a great interest and dynamic nature of this senior center. The topic today was given to me by Ruth Young about 6 months ago, and I said, yeah, sure, whatever. And so, because back in April, the market was still up, and I thought, well, all I have to do is talk about all that bad stuff that happened 3 years ago. Things are going pretty good, so I don't have to worry about this giving this talk. So, of course, then what happened? Of course, we had worries about an economic slowdown. We have, European debt crisis that just doesn't seem to want to go away. And of course, we've got Washington being dysfunctional and the whole arguments about, the debt ceiling limits, et cetera. And the market didn't react that well to that. So I have a difficult task. What I'd like to do, though, is to really try to reflect on principles that we really always knew, but they've really become more apparent because of this financial crisis. And I'll walk through that. I'll be honest, the first 2/3 of this is pretty serious because we've gone through a fairly serious financial crisis. You can't not, sugarcoat that. It's been pretty ugly. But I do want to leave with some hope and with some ideas about how to deal with the financial world out there right now. So here are the principles that I want to talk about. First one is government intervention is warranted during the financial crisis. The corollary to that is a debt problem can't be solved with more debt. At some point, you got to stop spending, okay? But they're both true, okay? So we're going to talk about that. Next, all investments have risk that are magnified during a financial crisis. And we'll talk about what that means. Next, the importance of education during times of weak economies. Why education matters. I'm not sure why we even have to reiterate this after the housing bubble, but your primary residence is shelter, not an investment. Okay, not your ATM machine. Okay, long-term stock average can be 10%. It depends on when you start counting. And investment return, either yield or growth today, is difficult to find. Okay, but there is hope. Okay, so let's dive in. This is just a brief summary, and I got to take liberties because I had to go back to 2007, which is 4 years, to find the market peak, which was October 9th, 2007. And you can see the financial crisis that we went through, boom, okay? And then we bottomed out in March of '09, and we were down 57% from the peak, okay? From the bottom, we then went up and we hit a recent peak back in April, end of April. It went up 103%. Now, one of my partners talks about the tyranny of numbers, and I'll call it asymmetric returns. And that is the fact that if you go down 25%, you got to come back 33% to get back to even. So if you go down 50%, you got to go back 100% to get back to even. Okay? Here we went down 57, went up 103, and we're still down from the prior peak. Okay? So this is what my partner calls the tyranny of numbers, or asymmetric returns. So here's what happened, though, as bad as that looks. Here's what happened with the involvement of government. You can get a lot more complicated, trust me. But here's what government did to have to jump into this financial crisis. Okay, what did they start doing? Oops, sorry. That's a problem when you put your finger and you're carrying too many things. Okay, so what did the government start doing? Well, they started easing interest rates because they were concerned that we were going into a recession. Okay, they then established credit lines, with the European Central Bank and sovereign banks around the world to make sure there was liquidity. Okay, what was happening? The housing crisis was starting to unravel. Okay, J.P. Morgan took over Bear Stearns with the help of the Federal Reserve Board. Okay, that was March of '08. Okay, so government actually helped facilitate the takeover of a company. Okay, that's being fairly proactive by government. Okay, then everything fell apart. Lehman files for Chapter 11. Guess what? They didn't bail out Lehman. Okay, they saved Bear Stearns, but they didn't bail out Lehman. Okay, so now the government's choosing what they're going to do and when. Okay, AIG, first bailout. And here's TARP. TARP was the financial liquidities being plugged into all the financial institutions. Okay, Federal Reserve Board authorizes credit line swaps with Bank of China, Bank of England, Bank of Japan, European central banks. Okay, so that's a fairly proactive thing. What are they doing? They're ensuring there's liquidity in the system, making sure there's liquid assets available to be able to be lent and be able to make sure that the financial system is fluid. Okay, Citigroup bailed out, and then another acronym, HALP, was created. And then we had our big stimulus bill was passed in February of '09, and then we're back to the trough again. Okay, that's a very active government that's providing liquidity and stepping in, and also deciding who they're going to bail out and who they're not. Okay, now the rebound. GM, bankruptcy. Now notice what starts happening though. Greece, Ireland, Portugal, second Greece bailout. What is this? This isn't no longer companies, these are countries. So now we've changed from a financial crisis to a sovereign debt crisis. So '08 was financial crisis. What we're dealing with now is sovereign debt crisis, with the budget problems in Washington, the problems in Europe. Okay, so we've transferred credit for sovereign debt problems. Okay, so now we're going to go back to a little bit of Econ 101. GDP is equal to government spending plus consumption plus investment plus net exports. Okay, so let's look at the components. Consumption. Consumer is 70% of GDP. We're at 9.1% unemployment, and the housing market is still not recovered. I'd call that pretty weak. Okay, investment. It is recovering. We're doing a little bit more R&D and capital expenditures, but it's just not moving the needle enough. And exports, it's negative because we're importing more than we're exporting. Okay, so add up the components. Weak, slightly improving, negative. Guess what? If you want the economy to grow, what has to be government spending? It has to go up. Okay, so this is Keynesian economics. It's saying that if we have a weak economy, we do need to have government step in. This is government involvement, and it's for a purpose. Okay, so here's a measure of what the stimulus is. This highlighted area was the stimulus that was voted after the two prior deficit and budget arguments last December, and these were the extension of the Bush tax cuts and the cutting of the payroll taxes. If we didn't have that, the stimulus would have dropped off significantly. So the fiscal year of the government just ended actually a couple weeks ago on September 30th. So September 30th, 2011, we just closed out that fiscal year. That bill last December was pumping this much more money into the system. If we don't, just from this year alone, if we have this amount of drop of stimulus, that's equal to a drag on the GDP of 1.6%. Okay, this is stimulus trying to support, GDP. Okay, President Obama proposed right now the $447 billion stimulus that's right now being, debated and driving around the country in a bus. If that were shown on this graph, it would be this gap right here and a bunch of fill in here. But it would still represent, at some point it's going to stop. Okay, at some point it's going to have to not continue. It will be a drag on the economy. Okay, but this is just an indication of where the government stimulus is being put into the system. Okay, so let's break down the components again. Mortgage debt is shrinking. Consumers are paying off their mortgage debt. Okay, so they're deleveraging. They're saving more, deleveraging, paying down debt. Okay, corporate debt isn't much of a problem because they got sufficient the debt for cash flow is actually not that high. So the corporations aren't a problem, and I'll go into that later because corporations are actually in good financial shape. But what has happened? There's your government debt has exploded. Okay, and that's the deficit spending. Okay, so spending was necessary. Spending was in the financial crisis. It got us through the crisis. Okay. However, a debt problem can't be solved with more debt. At some point, you got to stop spending. Okay, so we've been using this chart now for at least half a year, and we like it. And the reason we like it is on the left-hand side, it sort of explains the current budget situation. The blue line is tax revenue collected as a percent of GDP, so as a percent of the size of the economy. Why I like this chart is because it all the way back to 1960, so it's over 50 years, and we've had high tax and low tax regimes in this country during that period. And during that time, tax rate collected is either between 17 or 19%. Okay, high taxes, 17 to 19. Low taxes, about 17 to 19. Here are the Reagan deficits we had in the 80s. We actually had 2 years of surpluses with President Clinton. Okay, and then here we got the first Bush tax cuts right here. Okay, and then we're funding a couple wars. We got some Bush tax cuts. We got some surpluses. We got a bad financial crisis that Obama inherited, okay, and that goes to the roof. That's what we're spending right now, 25.4% of GDP, and we're collecting 16%. Now this chart is a little dated. Our revenues actually are starting to come back because personal tax collections are increasing. But even if I updated this chart, it'd really be only about up to here. Okay, we don't have a revenue problem, we have a spending problem. Okay, we're spending too much. Why are we spending too much? Well, we just went through that. We needed that for the stimulus to really support the economy. Here's what happens if we don't do anything. Here's your average between 17 and 19, about 18%, the tax revenues. And here's the spending on Medicare, Medicaid, and Social Security looking out 40 years. If you don't do anything, those three programs will engulf the entire federal budget. That means nothing else. No defense, no Department of Labor, no FDA, nothing. There's no other government except spending on those three programs. Okay, so this isn't going to happen because we'll turn into Greece somewhere around here. You just will have too much debt. We won't be able to finance it. So this is what's going on in Washington right now. Okay, Democrats say we need a stimulus because we got to juice everything up. We got to get everyone back to work. Absolutely, 9% unemployment is unacceptable. Republicans say, look, if you don't fix it, we got a problem here. We're going to run out of money, and we just can't do it by putting in too much debt. So what's the problem here? Well, we got a bunch of 7-year-olds in a sandbox throwing sand at each other, and they can't have an intelligent conversation. Okay? We got polarization. Okay, so but what's the most positive thing that's happened is like 10 months ago was the deficit reduction plan that came out from Erskine Bowles and Alan Simpson, 2 retired senators, who issued a report that said, here's how you deal with the problem. And the solution was about 1/3 of revenue changes, alternatives, changing deductions, flat tax, which increased revenue, and about 2/3 spending reductions. And if you did that, you would actually turn the curve and turn the debt needle around, and you could actually have a sustainable long-term future. Okay, what are we having instead? Well, we're not having any of that right now. We've got a gang of 12, and I don't know. There's some preliminary discussions about whether they're working together or not. I don't know. But November 23rd is supposed to be their deadline. If they don't, then there's across-the-board draconian cuts that are supposed to be put in place. So they sort of got a deadline, but I'm not hearing anything good. I'll talk a little bit about what that means, but I think that means we're just going to continue to see some market volatility until there's clear clearer resolution of that. Okay, so what we've been able to do in this country is fund this debt. The reason is because interest costs have been coming down. And this basically is mimicking the trend of long-term interest rates. So long-term interest rates are coming down, and so the cost of our debt is pretty low. The average debt outstanding is only 1.5%. Well, one-year T-bills are at 10 basis points, 1/10 of 1%. So you have trillions of dollars of debt outstanding that's now exploded, and we don't have to pay much for it. Okay, what happens though if interest rates go up 1%? That's a $140 billion hit to the budget. Okay, 1% from where we are right now. Well, I can't project what's going to happen in the future, but if we're near all-time lows in interest rates, and we're pumping more money than anyone knows into the system, at some point that's going to turn inflationary. Okay, at some point this interest cost is going to go up. That's stuff they haven't figured out on the budget how they're going to pay for. Okay, so we don't want that to happen, but we're putting a ton of debt on the books for the federal government. And at some point, if interest rate's going to go up, that's going to be a serious hit to the budget. Okay, next. All investments have risk that are magnified during a financial crisis. Everyone understands about risk and return. A couple of the presentations this morning were talking about higher risk, higher return. Everyone knows about that. And everyone, if there's a disclaimer, there's basically, these things are inherently, there's risk, blah, blah, blah. We live with risk every day, and we get adjusted to it. But during a financial crisis, it actually gets really highlighted. And let me point out a couple things. Okay, here is market correlation. And by correlation, I just mean when things move in the same direction. Okay, and what happens in financial crises is that everything moves in the same direction. And so this is just a measurement of stocks and when they move in the same direction. Look at the dates. Look at the dates. We've had 4 major spikes in times when everything moves in the same direction. And look what those dates are. U.S. debt downgrade this summer, Lehman default, Black Monday, which by the way was the anniversary was yesterday, and then Black Tuesday, 1929. Those are pretty severe financial crises, and what happens is everything moves in the same direction. Here's another set of graphs. You don't have to focus too much on what the actual components are, just the direction. So this is a measure of what happened to large cap, mid cap, and small cap stocks during September, October of 2008. All went down. Okay. Here's a measure of commodities. Okay, all went down. The only thing that actually did well was government debt back in 2008, and here it's going down. That's actually a good thing because that means price is going up. Everyone was running into government securities as a safe haven. Okay, I would argue though that maybe German and UK and USA debt now that we're moving into a sovereign debt crisis may not be as safe as everyone thinks. Okay, and then if you look at the correlation of the S&P 500, once again, how common is it for investments to move in the same direction? If it's perfectly correlated, it's 1. If it were perfectly non-correlated, in other words, something moves up, something else goes down, that would be a -1. So a +1 means it's perfectly correlated. EFA, Europe, Australia, Far East, these are basically the industrialized countries of the world, headlined by Japan and Europe, 0.94. Emerging markets, 0.89. Small cap stocks, 0.95. Mid cap, 0.97. Everything's moving in the same direction. Okay, so during a financial crisis, this relative risk is just, gets sort of taken off the side, and everything moves in the same direction. This is what I have problems with, I want to point out financial planners, but people who just use asset allocation blindly and say, oh, I've got some small cap value of this, or I've got some mid cap growth of that. Guess what? Financial crisis, it doesn't matter. Everything goes in the same direction. Okay, so even with the safe investment, though, you've got some risk. And so I'm going to show this a bunch of different times. You're going to see the word real. So whenever you see the word real, think the investment return minus inflation. Okay, and that'll give you the real return against inflation. So this is looking at the real return of 3-month T-bills. And most of the time, it's generally positive. The times when it went down here was when the Fed was dropping interest rates after recessions of 91 and 01, okay? And they were trying to pump up the economy by dropping interest rates. 3-month treasuries came down, there was still a little inflation, but you were still getting basically a 0 real return, maybe a little negative here. And then here's the financial crisis, boom. It actually went positive here, not because 3-month treasuries went up, because inflation went negative. Okay, so inflation actually went negative here. So your zero return looked pretty good because inflation was actually going down. Okay, but now what's happened? Inflation has come back a bit. You're still getting zero on your 3-month T-bill, or close to it. And you're now losing almost 4% annually by owning T-bills. Okay, that's a risk. Okay, it's a safe investment, I hope, absent maybe what went on with a government default risk that we had with the debt ceiling this summer. But for a supposedly safe investment, you're losing 4%. Okay, so next, a little segue. Let's talk a little bit about something different, but something that's really come to our attention. The importance of education is more evident during weak economies. Unfortunately, here's the unemployment rate based on income category, various income categories, and there's a pretty strong correlation. Unfortunately, those at the lower end of the income stream, income levels, have higher unemployment. But look at the difference between 07, which is blue, and the last 2 years, 2010, 2011, okay? Those at the lower end of the scales have been disproportionately affected by this financial crisis, okay? Here's where it really, really points out. Those with no high school diploma, unemployment's up around 15%. Somebody with a college degree, down by around 4%. Okay, this really points to the importance of education, maintaining skills, being productive. If most of you have grandchildren, by golly, fund their 529 plans, fund their ability to go to college, encourage them to stay in school. If anything, the ability to get through the financial crisis and get out on the other side is really going to be driven by the ability to have value added through your education. Your primary residence is your shelter, not an investment. Okay, we are almost like, why do we even have to talk about this? Here's the bubble that we went through. What I did want to point out, though, is the fact that it's fairly regional. And I could have thrown in a whole host of cities instead of Miami. I could have put in LA, Tampa, Scottsdale, Arizona. We do have Las Vegas in there. Everyone knows sort of where the bad bubbles were in housing. Kind of interesting, though, that we had a couple parts of the country where we didn't have a bubble, Dallas and Detroit. And of course, Detroit's been disproportionately affected because of the manufacturing and the Motor City population loss as well. And then you can see good old Boston. And here's a bit of good news. Boston actually stacks up pretty well. We did, have a little bit of a housing increase, but our decline has not been that much, and we may have stabilized. I know we've got a couple real estate people here, but the housing market actually may be doing better than the rest of the country. Primary reason probably is because we didn't overbuild, because we already fairly developed in this metro area. There wasn't a lot of overbuilding like there was down in Miami or out in the Southwest. Let's take a trend, though, and go really far back and look at, once again, that word, real. So taking inflation out of the housing price. And let's look at home prices going back over 100 years. And you can see that housing prices generally have stayed about the same. Housing is not an investment. Housing tracks inflation. Okay? Here's the bubble, and there's the crash. And maybe there's slight influence that we might have for population as we build out more urban areas. Maybe the select nature of certain real estate in certain areas might cause real estate to trend upwards. But housing is not an investment. Okay, it tracks inflation. And the only reason it didn't track inflation was we got into that whole fancy thing of no money down, low credit, subprime loans. I don't even want to go through all that. Everyone knows exactly what that story is all about. And how we're going to really solve the housing crisis is to get through the foreclosure logjam that we have. Okay, so this is just showing the measure of delinquency, number of people not paying in 90+ days, what the inventory of foreclosures are, and then how many foreclosures were started. And hopefully, maybe we've trended off. Maybe this is good that the number of people who are overdue by 90 days is starting to come down. The housing crisis will not get solved until this backlog gets through. Okay, so we're not going to, solve that until we get through this backlog. Okay, next, stocks can average 10% a year, but it depends on when you start counting. So let's take a real long-term picture of this. Here's a long-term trend of the stock market going back to 1849. Okay, So once again, we got to look at that word real, okay, so we're taking inflation out of this, okay, and the trend line shows about 6%. So if you have about 4% inflation, there's your 10% stock market return right there, okay? And all these lines are just trying to show us that there's a band around it. But look, there's major periods where you have secular bull markets, where things actually do really well for long periods of time, and then we've got some bad periods. Pretty easy to pick out the Great Depression in here, okay? The two places I'd like to point out, though, are right in here, and the other one is right in here, and of course where we are here today. Okay, so this is just an anomaly. I don't know why this happens, but the market seems to have trouble getting over Dow at multiples of 10. So back in 1906, we did hit Dow 100 and didn't cross again until 1924. Okay, Dow 1000, almost, call it 1966, didn't cross until 1983. Until further it kept going on and on. And we hit Dow 10,000 back in 1998, and here we are today. I don't know why this is, why magical numbers. I think it's just, well, it is. It's just a random. But these are different eras. This era here was noted by high inflation. Okay, we've had a couple OPEC in embargoes. We had a nasty recession in '74. Okay, but this was in a different environment. This was high inflation. And it wasn't until Paul Volcker broke inflation in 1982 and brought inflation down that we finally cleared, and then that was the beginning of the bull market in the 80s going in through the 90s. This is actually an interesting era because this was also a credit crisis. And in 1907, we had what was known as the Panic of '07. Anyone remember that Panic of '07? And it was a banking crisis where banks went under. What saved it, or at least what stepped in, was John Pierpont Morgan, J.P. Morgan, the individual, not the bank. He stepped in, and why is that? Sounds a little familiar. What's Warren Buffett done lately? He's been investing a whole bunch of money into financial institutions on very favorable terms, but he stepped up and put in some big money. Okay, so the similarities of this era here are pretty good. I'm not a student of the teens, other than I know World War I was in here, and then of course we stepped off in this era into the roaring 20s, and of course 29 we know what happened with excess debt. Here's another way to look at historical returns, and this is looking at 10-year rolling averages. So stay with me for a second. 1938. So take the 10 years ending 1938. So 1929 to 1938. Take the 10-year returns, add them up, divide by 10. The average return for that 10-year period was -1. Okay? As you roll through each year, you add a year, but you drop another year off. And so as we roll through the 30s, we get out of the Depression era, we go into the 50s, we actually peak out in 58 at around 20%, and then we roll back over again. We go into the 70s, which I talked about in terms of being a flat market, and we bottomed out at 1974. Now, 74, that was a bad time. I remember 74. Nixon was resigning in there. We're getting out of Vietnam, OPEC, high inflation. Your win buttons from Jerry Ford. Anyone remember those? Whip inflation now. That was a very popular thing to see if we could break inflation. How did that work? And then we roll into the 80s, we know the 90s, okay, and then we roll over, and here we are in 2010. Now, the only thing positive to say about this is that this 10-year period, and by the way, the lowest was in 2008, was as bad as the Great Depression. I mean, that's probably the best thing you could say. So we've wiped out a lot of excess. So we had the dot-com era, the resurgence with the whole subprime issue, then the housing crisis and the bubble, and now this sovereign debt crisis that we're dealing with. We've actually swept a lot out, so that's the good news. And it doesn't take much to move this back. But it's very interesting to see the cyclicality of the nature of these 10-year returns. I would say you're far better off as an investor having started investing here, certainly, than having put your money in there. Okay, so it really does depend on when you start investing. Okay, so investment returns, either yield or growth, are difficult to find today. However, there is hope. So let's try to find some of that hope. Here's just a table of various investments looking by yield. So let's just break it down. Cash. And all of these are referencing our Vanguard funds, which I just find are very clean, very simple. They're just pure what they say what they are. There's nothing more fancy. So their money market fund yields 0.03%. Okay, near zero. Okay, you can get a 6-month T-bill for for 0.5%. Okay, 5 basis points. You're not getting paid anything. Okay, so now let's step off into the risk curve. And I want to say there's risk with Winchester Savings Bank over on the side here, but you can get a 3-year CD for 1.24%. They're good for it. Trust me, they're good for it. But that's the yield for Winchester's 3-year CD. Short-term corporate bonds, 1.89. Now you're taking on a little bit of credit risk. Mass tax-exempt bonds, 2.5%. That's kind of interesting. That's not even adjusted for your federal and state income tax. If you do that, it's about 3.9 on a pre-tax basis. That looks pretty attractive. Okay. Inflation-protected bonds, that's kind of interesting. This is a Vanguard product that's selling at negative yield. Negative yield, let's think about that. You're actually paying to be in the product. Okay, now I'm not going to get to the intricate nature of inflation-protected bonds, but basically you get the value of inflation tacked on to the value of your bond, and that's how. So people are buying these TIPS, Treasury Inflation Protection Securities, and pushing the price down. Pushing the price up until you've got a negative yield. And the reason they're doing that is because they want to protect against inflation. So there's an inflation adjustment. And these things do act as Treasury securities. So when Treasury yields went, the yields went down, the price went up. So the total return for the whole year was 9%, even though right now you're getting a negative yield. Okay, so now what happens when you start stretching for yield? Now you get into some long-term bonds, okay? About 4%, okay? But look what happens in the total return. Didn't do so well. Why is that? You got the income, but the principal value declined over the course of the year. Same thing with high yield bonds. Okay, so now you're really stretching for yield. Up 7% for the 1 year trailing though, only up about 2.9%. So you took on some risk by trying to look for yield, but your total return wasn't so hot. Okay. Oh, so let's now step off into the stock world. I'll show you in a second that the S&P 500 is yielding about 2.2%, but you can get into some high dividend stocks, and you can get a diversified portfolio, and just not utilities, and get about 3.5%. Now, if you try to go off into preferred stocks, yeah, you can get more in terms of a yield, but look at that. You get that, there's that total return number again. It's all different, okay? And you can do real estate. Their real estate fund's a little funky, so you can get other real estate. Vanguard's real estate fund is a little funky. They report yield. I won't get into it, but you get my drift. You can buy some real estate and get some yield, but once again, your total return is going to possibly vary. The one thing I will point out, though, and these aren't Massachusetts, just national AA munis, is right now the AA munis yield on a gross basis, this is not tax adjusted, more than U.S. Treasuries, okay? And the default rate, I'm not going to be selling here munis here to you, but high quality munis have a pretty low default rate. Ask me afterward, I'll show you a table that just shows that high quality munis have a very small default rate compared to corporate bonds. So on a tax adjusted basis, even though you're only getting about 1.7% at 5 years, on a tax adjusted basis, that's it's close to 3%. So that's actually a fairly attractive area. The one risk you have, though, is that you step out further with these relatively low yields. A 30-year Treasury at about 3%. 30 years. Okay, inflation doesn't have to creep back that much before the value of that bond is going to plummet. And then you're stuck with a bond that's for 30 years at 3%. I don't know too many people want to sign up for that deal. Okay, so let's talk about the dividend-paying stocks. Now this is the S&P 500, so it's the entire index, and comparing that to 10-year Treasury yields. And you see yields up, yields down, and that's you've seen that before. But this is for the first time we've had that dividend-paying yields on the S&P 500. The average yield is higher than 10-year Treasuries, and we haven't had that since the 1950s. Okay, so I would offer that a good quality dividend-paying stock, if you're willing to tolerate the volatility, is not a bad way to go. I wouldn't do it for anything to do with capital preservation. I wouldn't do it, if you're looking for the steadiness of income. But the prospect of owning a good quality stock, which by the way might increase its dividends over the course of time, and you're only going to get 2.1% on a T-bill, on a Treasury note. That's it. They're not going to pay you more. But your dividend-paying stock may end up increasing in yield over time. So let's take a look a little bit at the state of where corporations are. Here's, oops, did that again where I think I'm pointing, but I'm not.
because the new things are so persistent.
They're too easy to use.
Yeah, if you touch one and you could.
Absolutely. So here's the liquid assets on non-financial corporations, and we're up over $2 trillion. Okay, so corporations are sitting on a boatload of cash, and on a historical basis, this is cash as a percentage of GDP, and that's goes as high as it's ever been since the 1950s. So financially, companies are in really good financial shape. Here's some news you don't see in the newspaper too often. Undistributed corporate profits, all-time high. Okay. So you can see, obviously, the crash, and the recession, things caved in. Boy, they came roaring back, and their companies are making profits. Okay, so we've got a weird thing going on right now, where we've got this whole financial crisis, now we've got a sovereign debt crisis, and on the other end of the spectrum, we've got healthy corporations that are operating very, very efficiently and effectively. And then in another measure is looking at a long-term trend. This is 10 years earnings on a PE ratio, price to earnings. So E being earnings and what price you're willing to pay. Most people say, well, the PE is usually about 15. Again, remember, I'm totaling up 10 years worth of earnings. So the historical earnings are lower. So by the time you add up the 10 years worth of earnings, the PE ratio climbs. But on a historical basis, I won't say we're absolutely cheap. I wouldn't say let's go run out and just load up my entire savings account with dividend-paying stocks. But I would say that we're not overly expensive. I have had clients in the last 2 weeks, and as I've shown this, say, "Why didn't you tell me it was expensive back in the dot-com era?" I'm sorry. We all thought it was a different era, but that's a different time. That was history. So there we have it. There's our my seven principles of what we've dealt with in this financial crisis. With that, I end. And if anyone had any questions, we've got a couple minutes, and be happy to answer them. Yes.
One asset class, we call it an asset class, gold. We talk about
Right. I didn't talk about gold.
very recently correlation with.
Well, gold is a negatively correlated asset, right? And,
Any news about gold?
yeah, I didn't want to get into gold. I did that on purpose. Gold is stored value. It's not really an investment. You can talk about gold stocks. It is non-correlated with many other different things. It's a stored value of money, but it's not. It has no earnings, and its perception is driven by either crisis or inflation. So I did not purposely talk about that, but that is certainly you hear it on the radio. Buy gold bullion, buy gold coins. We do use gold as a diversifier. I do tell clients though, if you really think gold is going to be the solution, then you're not going to talk about anything else in your portfolio because everything else will have done really badly. If gold does really well, I mean really well. If it's a total, because then you've got a meltdown of everything else, and I guess I'm not in the mood of saying, the United States government and our economic system as we know it is going to stop being. So it's just not a direction that I want to go in. Yes.
How come it is that your savings, like the bank I go to, my savings, I get only 8 cents interest every month?
Unfortunately, correct.
I can't even buy a cup of tea.
Unfortunately, I hate to say this, you're absolutely right. And what I'm doing is I'm just going back to that Treasury.
Oh, it's because of the treasury?
No, it's because of inflation and maybe no, here we go. Importance of sorry. Unfortunately, the reason is because we've got Federal Reserve has pushed down short-term interest rates to try to push the economy. Unfortunately, it's being done on the back of savers. Savers are being disproportionately penalized in this environment. Okay, everybody here, and even me, who has a savings account, you're paying for the liquidity to pump this economic system ahead, but you're paying for it with negative real returns because inflation is still running 3-4%, and that's a problem. And I don't have the answer for that. Let me ask you though, but when I go around and look around, because you're not the first one who's asking where do I get the yield, there is no safe place for yield without taking on risk. And unfortunately, savers right now are getting disproportionately punished because of our current economic situation. Yes?
One of the gentlemen at the bank that I told you said that the reason for not the yield in the bank, you know, I'm talking about around here, is because we're $3 trillion in debt because of the credit card crisis, and the banks own the credit cards. And they also own insurance companies own banks, is that correct?
Yep.
And also because of the foreign, some of our banks have been taken over by foreign.
I wouldn't necessarily think that's one of the, but the first part you talk about, I would say is all true. And I would add on top of that, it's just not credit cards, it was the financial crisis and all the bad debt. So the banks are, yep, so everything you say is true. The banks are we're in a bad financial situation, and they had a lot of bad debt, and then right now they had, you know, it's run to the Fed for liquidity. You're absolutely correct.
So we're talking a bit more about the hope.
Well, I'm trying to give you the hope in the sense that if you are a long-term investor, there is hope that I think we've gotten through the majority of this financial crisis. The hope is that I think we have to wait a little bit, but the hope is that Washington actually gets its act together. Right. There's a lot of coughing and thing. But I tell you this, the expectations, the bar of expectations for Washington doing anything is so low. If they do anything, the market will have a huge market run because nobody expects Washington to do anything. So I think the hope is that our economic system has had stresses like this in the past. We've gotten through it. I think the hope is that we've already gone through 10 years of difficult market periods, and that history has shown that we've found a way to come out of it. I think the hope is that individuals are acting rationally, are paying down debt, and they're responding to this financial crisis by restoring, sanity to their balance sheet, to how their finances look. So I think that's the hope. The hope isn't from somebody who tells me they're getting 8 cents a month on interest rates. That's not, you're right, that's not hope. But I think we'll eventually get through that, and the financial system will repair itself, and we'll move on. Yes?
Can you comment on the day-to-day volatility of the stock market?
Right.
Is this recent? Is this the way the market's going to be? What do you think?
Well, remember one of the first charts that I showed you was that the fact of the correlations when they spiked during a financial crisis. So since this recent financial crisis, concerns about the debt ceiling back in late July, early August, partners of mine in my office were commenting on the fact that our screens are either all green or all red any given day. Either the market's all down or it's all up. And we're seeing that volatility and that all the stocks moving in the same direction. It is a more frequency. I didn't put it on the slide, but you raised the question. High frequency trading. This is traders coming in with algorithms that are programmed, that are not even being push buttons by humans anymore, that are going and buying and selling things on a microsecond basis. And that's representing about 60% of the volume of the New York Stock Exchange. And we think that's a problem, because I don't think that's really serving the investor properly. And their talk about, we're providing market liquidity, I think that's just bogus. I think you install the uptech rule, and I think you put a short-term profit on their trading activities, and you'd wipe all of that out.
It's how much of a factor are the institutional buyers? Some of these stocks are 60–80% owned by institutional.
Yeah.
And of course they use these automated trading triggers.
Right, but I differentiate on that a little. Go ahead. I'm sorry. Go ahead.
But I was wondering what factor the institutions.
Right. Well, I would separate that. I would say hedge funds are more likely to be using these algorithms for the high-frequency trading, and private investor pools. The pensions, which is the other side of institutions, they're long-term investors. They're really not in the game for short-term trading. So I would differentiate the institutional ownership of, say, a high-quality company between the nature of who is the long-term investor in that. And pension funds, insurance companies for their investment pool, they're long-term traders. It's really the short-term guys who are hedge funds that are doing this kind of stuff. Bonds.
What are good bonds?
Well, I think I pointed out some municipal bonds, I think, that can represent some both quality as well as an attractive yield. Series E, well, now you're talking about, savings bonds. I don't know that much about it, but the I series bonds, I know that the I bonds do offer an attractive yield. You can buy them direct at treasurydirect.com. That's more on a personal basis as opposed to more of my investment focus. But that is an alternative, so I would look into that because I have read recently that their yields though are coming down because I do know that they are offering on a relative basis more attractive yields. Yes.
Does the laddering of treasury concept still valid?
Yes, yeah. If you're going to own a portfolio, laddering the portfolio will minimize the risk if interest rates rise. So that concept definitely is still a viable one. So what you do is you buy 1, 2, 3, 4, 5, 6-year bonds, and then as your 1-year bond rolls off, you go out and buy the next 6-year bond. And what that does is if interest rates go up, it minimizes the impact to your portfolio. And by the way, as the interest rates go up, your next purchase is buying a higher interest rate bond. And so it's a viable way of dealing with rising interest rates.
I just have a question. What do you think the impact of all this protesting going on is? Do you think it's going to have any impact at all?
I walk by them, the days I drive in, I go to the South Station, so I walk by them twice a day, and I stop by and I sort of stare, and it's a little bit unfocused, I'm not sure, but some of it's a little bit off track. I mean, at lunch or at a break, I was talking to somebody, and we were talking about this, and I said that one of their mantras is they want the forgiveness of all student debt. I'm like, well, wait a minute, you signed up for this, you got an education, now you don't want to pay it back, and I'm going to pay for it? So that doesn't make too much sense. No one told you to take that debt out. So I'd go back to that education slide that says that, education really is the solution. And so getting back to your question, I think these people just got to go out and get a job. And they may have to step down 2 steps to find that job. But telling me they don't get a job while they're camped out and making mud piles right across from the Federal Reserve, I don't get it. But at my age, I'm even not the right generation. Yes. Anybody else? Great. Well, it's been wonderful to have you here today. And it's been a pleasure. Thank you very much.